So you've got a home loan and you find yourself with a little extra cash each month. You're standing at a massive financial crossroads. Do you throw that extra money at your loan to pay it off early? Or do you start investing it to build up some serious wealth for the future? It's a classic dilemma, and today we are going to get to the bottom of it. You've probably heard this advice a million times, right? It sounds incredible. The idea is, hey, if you invest your money and get good returns, it can pretty much cancel out the interest you're paying on your loan. But is it really that simple? Is that always the best advice? Let's dig in and find out. Okay, so this is the heart of it all, security versus growth. Do you get rid of your debt or do you invest? To get a really clear answer, we're going to skip the theory and just run the numbers on a real-world scenario. Let's meet Ajay. He's our case study for today. He's just taken out a home loan, and we're going to use his situation to compare these two strategies side by side. So let's take a look at his numbers. Here's the deal. Ajay has a 50 lakh rupee loan. The interest rate is 7.5%, and the loan is for 20 years. That means his monthly payment, his EMI, is 40,280 rupees. But here's the kicker. Ajay finds himself with an extra 8,000 rupees every single month. And this brings us to the main event. What should Ajay do with that extra 8 grand? He's got two very, very different paths he can take, and each one has its own logic. So let's break them down one by one. First up, we have path 1. We'll call it the parallel SIP. This is the strategy you hear about all the time. The idea is Ajay keeps paying his normal loan EMI, and with that extra cash, he starts a systematic investment plan, or SIP, on the side. The plan is super simple. Ajay just pays his standard EMI for the full 20 years, no changes. At the very same time, he starts putting that 8,000 rupees into an SIP. Now, we're going to assume a 12% average annual return, which is a pretty typical long-term expectation for stock market investments. The key here is consistency, doing this for the entire 20 years. All right, now for the alternative. Path 2, the prepayment plan. This is the get debt-free first approach. The whole philosophy here is to attack that loan with every spare penny, clear it as fast as you possibly can, and only then do you start thinking about investing. So, this path has two very distinct phases. For the first 14 years, Ajay adds that extra 8,000 right on top of his EMI, paying 48,280 a month, and by doing this, he pays off his loan a whole 6 years early. Then, for those final 6 years, he takes that entire amount, the full 48,280 rupees he's now freed up, and pours all of it into an SIP. So before we see the results, let's just quickly recap. Path 1 is all about investing a small amount for a very long time, building your wealth while you're still in debt. Path 2 is about clearing that debt first and then investing a much larger amount for a shorter period. Two very different ways to get to the same goal. All right, the moment of truth. We've run all the numbers. After that full 20-year journey is over, which strategy left Ajay with more money in his pocket? Let's find out. In Path 1, after 20 years of just paying his regular EMI and faithfully investing in that SIP, Ajay's investment grows to approximately 1.51 crore rupees. Wow, that is a very impressive result. And for Path 2, after all that work of prepaying the loan and then investing like crazy at the end, Ajay's final amount is about 1.28 crore rupees. Still a fantastic outcome, no doubt, but clearly less than Path 1. And here you can see it plain as day. After 20 years, the parallel SIP strategy leaves Ajay with a significantly bigger pile of cash. But how much bigger are we talking about? Well, the difference is what really matters here. Choosing Path 1 over Path 2 resulted in an extra 23 lakh rupees in Ajay's pocket. I mean, that is a substantial amount of money no matter how you look at it. Now hold on a second. This might seem completely backwards, right? In Path 2, Ajay was investing over 48,000 rupees a month. That's way more than the 8,000 in Path 1. So how on earth did the smaller investment win? Well, the answer lies in the single most powerful force in the world of finance. It's the power of compounding. This is the secret sauce. It's that magical effect where your money starts making money, and then that money starts making even more money. And the most critical fuel for this compounding engine isn't how much money you put in, it's time. And that's the entire story right there. Path 1 won because that little 8,000 rupees had 20 long years to grow and compound on itself over and over again. In Path 2, even though the investment was much, much bigger, it only had 6 short years to work its magic. That longer runway for growth made all the difference. So, if there's one golden rule you take away from all of this, let it be this. When it comes to investing, a smaller amount given a long time to grow will almost always outperform a larger amount with only a short time. Time is your greatest ally. It's your superpower. So does this mean prepaying your loan is always a bad idea? Not necessarily. Remember, paying down your loan is a guaranteed risk-free return. You know exactly what you're getting. Market investments, they're not guaranteed. The math we've shown is based on long-term averages. But at the end of the day, finance is personal. The peace of mind that comes from being completely debt-free has real value that a spreadsheet can never, ever capture. The right path for you depends not just on the numbers, but on your own comfort with risk and what helps you sleep at night. Definitely something to think about.